Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. 2 weeks ago I said, and I quote, "So a significant move right from the start of this week, with consecutive closes below the lower bull channel line of the imperfect mid-January to date bull channel. What looked like the market eyeing 2 weeks ago the resistance top side of the 50% Fibonacci line of the May to August 24 move at 630 and possibly the 50% Fibonacci line of the March to August 24 move at 658, so one's from May, one's from March. Well, they turned out to be prices taking fright at these and turning lower," end of quote. Prices dropped down last week down into a congestion zone stretching from about 540 down up to 566. Last seen between November last year to January this year, and earlier between late July to late August last year. This is where the market finally took a breather, amongst the purple declining neckline of the February to April reverse head and shoulder pattern from 2024, currently at 548. The bright red lower time, currently 544, and the very shallow late August to mid-January bullish shift pitch fork, and a little above the 38.2% Fibonacci, absolute Fibonacci line of 521 that had supported the market back in August last year. Now, overhead we have a pair of moving averages close together, and to be honest, these did not provide much support on the way down and might not provide much resistance on any move higher, but they are still there, consisting of the flatlining green short medium moving average currently at 569 and the very slowly declining medium moving average currently at 568. However, these two, along with the short moving average currently 568, are right now forming a bow tie formation crossover. The moving averages are not in the right order, but they are most definitely forming a bow tie formation with, right now, some slight bearish overtones, though this is, of course, may change. So what you have to look out for is in between 15 to 20 sessions from today, so between the 4th to the 10th of April, look out for one or more of the following: a change in trend, a reinforcement of a trend, and above all, volatility. In recent days, what has been left behind in the wake of this market ever since at least mid-January, and realistically could be seen as since late November last year, is a V-top that's part of a larger bump and run reversal pattern top. The question now is, will the market extend the move lower below the congestion between roughly 540 to 566? So far it has not done so, as the combination of the purple neckline and especially the bright red lower time below have supported the market for a second week. However, I have labelled these last 3 to 4 days as a V-bottom, but one that may be building to a possible bearish halfway hesitation. This is one course of action for sure, but it might be something else. And I have considered, though not as yet labelled, the idea of the whole of 2025 being a possible diamond bottom pattern type. It may not be a good example of such a pattern, but it does have the possibility of being one. I'll apprise you more on this as it develops, as well as the bow tie formation. Chicago corn. A major move at the end of February and going into March. The end of the upwards move we've seen here since the start of the year, and a gradually sharper move lower. The key feature were the consecutive closes below the early December 2024 to late February this year uptrend, which is also the lower trend line to a mid-January to late February ascending wedge pattern, plus moving back below the significant 50% Fibonacci line of the June to August 2024 move at 505. Prices broke down further below the congestion band 491 to 498. The reason for this turn and fall low were laid out by me 4 weeks ago when I said, and I quote, "We might still see further hesitation as though the topside seemingly has limited resistances. The ones it does have, and there are 2 significant ones, they are likely to cause some second thoughts. See, not far overhead we have the combination of the October 2021 low and the 50% Fibonacci line, with the June 2013 to February 24 move, both at 516. Then a little higher still we have another significant congestion combination with the 2014 high and the 61.8% absolute Fibonacci line, both at 525. These will be the levels to watch out for," and that's the end of the quote. The fall pushed down through the green short medium moving average, currently at 484, which had between September and December 2024 shown a significant support to this market. Then last week pushing below the bright red lower trendline extension up to the July 23 to January 24 descending triangle, currently at 462, and also the slowly rising mauve medium moving average, currently at 463, all the way down to a fairly free zone till the flatlining gold long moving average, currently at 441, where prices were stopped dead just short of it and pulled back up. The pullback up has been interesting as it stopped on a closing basis at the 38.2% Fibonacci line at 472 of the whole recent move down during the last 4 weeks. So this week we started back up over the combination of the mauve medium moving average and the bright red lower trend line, though as I said last week, and I quote, "How good a support they might be is debatable, given how they acted only earlier this past week," end of quote. This qualm of mine turned out to be true, as in 3 of the days of this week we have been below both, and we are now once again below both as well. This raises the question as to whether we have potential here for a further bearish halfway hesitation or a double bottom. It is too early to say right now, but please keep these 2 thoughts in your mind, as I will. Now, 2 final points which I also raised last week. I thought about considering the action since late November last year as a possible bump and run reversal pattern, but after much pondering on this, I think this is not possible. I continue to think so. The primary reasons are the shape of such a pattern does not fit here, and the uptrend since early December last year is far too acute to qualify. Secondly, I've drawn a late November 24 to early March 25 bullish shift pitchfork for the recent move. I chose the less acute bullish shift pitchfork instead of the more acute bullish Andrews, mainly because the overhead middle time, currently at 484, was closer to the market last week than any other times. This week, prices are closer to the lower time, currently at 444. I would of course morph this in an instant to the more acute bullish Andrews pitchfork, if it becomes appropriate. Kansas City wheat. Last week I said, and I quote, "So a significant move right from the start of this week, with consecutive closes below the lower bull channel line of the late January to date bull channel. What looked like the market eyeing 2 weeks ago the resistance topside of the January 2015 high at 646 and the high of early October last year at 632, well, that turned into the market taking fright at these and turning lower," end of quote. Prices in the early part of last week bottomed out at the dark blue lower time of the very shallow late August to early January this year bullish shift pitchfork, currently at 543. Now there is a valid argument that you could remove the shallow pitchfork, the shallow bullish pitchfork, and just use the early December 2024 lows, especially the low closes as a support that finally stopped the decline, and I'm not arguing against that. Since then, prices have moved back up over the unusual purple lower trend line, currently at 570, from the November 23 to April 24 descending triangle, as well as the flatlining mauve medium moving average, currently at 576, the green short medium moving average, currently 583, and yesterday and today trying to push up over the gold long moving average, currently at 585, as well as back up over congestion between 550 to 570. Dating from November last year to January this year. In the overall picture, much like Chicago wheat, the market here has been the story of what has been left behind in the wake of this market's move, ever since at least early December last year, which is a longer period than seen in Chicago wheat. and it's a V-top pattern that's part of a larger bump and reversal top pattern. However, the difference here has been twofold. It has been the dark blue lower tine of the late August to early December 24 bullish pitchfork instead of the bearish Andrews pitchfork, providing the angle for this market. And we do not have, at least not yet, a bow tie formation of the moving averages here. Additionally, the bump and run reversible top is of a shallower angle compared to Chicago wheat, which for a while gave the market the opportunity to try even lower, but which it chose not to undertake. 2 weeks ago I said, and I quote, "The market has achieved just about all its goals on the downside move, and it may be that prices are instead organising for a different pattern and a new move," end of quote. This time I was correct in my view. Thus, I have labelled these last 3 to 4 weeks as a V bottom, but one that may be building to a possible bearish halfway hesitation. This is one course of action for sure, but it might be something else, and I have considered, though not as yet labelled, the idea of the whole of 2025 being a possible diamond bottom pattern type. It may not be a good example of such a pattern, but it does have the possibility of being one, much as Chicago wheat. I'll appraise you more on this as it develops. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.